Fear, uncertainty, and doubt. Is now really a good time to think about investing in property? Hi everyone, thanks for watching. I'm trying a video format for the next few weeks. If you prefer to read the article, just scroll down to the link below. Okay, so there's a lot of noise out there at the moment, a lot of FUD, fear, uncertainty, and doubt. Markets are volatile, interest rates are rising, inflation is back in the conversation, and a very fair question I'm getting from people right now is this really a good time to invest in property? So today I want to walk through that with you. We're going to look at what's changed, what hasn't changed, where the risks are now, and how to manage them. So firstly, what has changed? Let's start with the obvious. Interest rates. We've still got upward pressure on inflation, which means there's a reasonable chance of further rate rises in the short to medium term. That has a real impact. It reduces borrowing capacity, and for many investors, it changes what they're comfortable spending. Number two is construction costs. Build costs are rising again. Now, this is a bit of a double-edged sword. If you've already built or you've locked in a build contract, you're actually in a strong position because the replacement cost of your asset is increasing. The next person trying to build the same property will likely pay more than you did. On the flip side, when build costs rise too far, projects stop stacking up. Developers pause, supply slows down. I've seen this firsthand. When feasibility disappears, new supply stalls. And when supply drops, that creates upward pressure on prices over time because the demand is still there. Number three, policy and tax settings. We've also got the federal budget coming up in May, and there's been a lot of commentary around potential changes to property taxation, including negative gearing and capital gains tax exemptions. The latest headline this week from Jim Chalmers is that he's looking to hammer foreign investors by clawing back the last 20 years worth of capital gains tax. We'll see how that goes. At this stage, though, it's still uncertain. But the way I see it, it will likely be a two-edged sword with some winners and some losers. For example, we may see more tax incentives pushed towards new construction. Given how undersupplied we are, that would make sense. Now let's look at what hasn't changed. This is the important part because the headlines and sentiment shift quickly, but the fundamentals don't. So number one, population growth. Australia's population growth has not slowed in a meaningful way. We still have more people entering the country, more people needing housing. Number two is housing supply. We are still significantly undersupplied. The federal government has a target of building 1.2 million homes, and we are well behind that. That gap does not close overnight. Number three is rental market conditions. Vacancy rates are extremely tight. According to SQM research, national vacancy is currently sitting around 1%. Rents have increased about 5.9% over the last 12 months. Now that's what undersupply looks like in real time. So when you zoom out, you've got this dynamic. Supply is constrained, demand is persistent, replacement costs are rising. That combination doesn't tend to disappear because of short-term uncertainty. It's worth remembering the last time we saw a cycle of aggressive rate rises, 13 in a row, the property market still went on to perform strongly. Now, there were other factors at play back then, particularly increased money supply, which we don't have to the same extent today. But the key point is this: interest rates alone don't dictate property prices, although they have an influence. So what should you do? If you're looking at this market, the goal isn't to avoid risk completely, it's to manage it intelligently. Here's some ideas to help you lower your risk. Number one, focus on buying in affordable markets. So right now, more affordable areas are generally holding up better than the premium markets. That's where the demand stays the strongest. Number two, create headroom. Don't max out your borrowing capacity. So if you can borrow $1 million, maybe you buy something for 800,000. If you can borrow 800,000, maybe spend 650, etc. That buffer matters, especially in uncertain times. Number three, maintain cash buffers where you can. This gives you flexibility if rates rise further or cash flow tightens. Number four, be conservative with your debt structuring. Lower loan to value ratios can make a big difference right now. So more equity equals less debt and less pressure, therefore, from rising rates. Number 5 is play the long game. Property is not a short-term game. If your time horizon is 5 to 10 years, the fundamentals will stack up well. And number 6, understand your alternatives. If not property, then what? Cash? Well, that's losing value at the rate of inflation every year. Shares, crypto, commodities, far more volatile than property. Now, every option carries risks. It's about choosing the right one for you. In my experience, the biggest risk is often in doing nothing because of fear. We saw that during the 2020 and 2021 period. Many people sat on the sidelines out of fear and missed out on one of the strongest growth periods we've had. And speaking from experience, every client I had who invested through that uncertainty built very substantial equity in their properties and have had very strong rental growth increases as well. There's a saying, fortune favors the bold, but I'd add bold, not stupid. Make smart decisions, get good advice, understand the risks, and structure yourself correctly, and you give yourself a very good chance of doing well in this market. If you want to talk through your situation, feel free to reach out. You can click the link below. Thanks for your time. Have a great week.